Hi, it's Lee and welcome to the Tesla Economist. Continuing on from our forecast of Tesla's financials for 2023 if we went into a recession. In the previous videos, we'd calculated what Tesla's cost of goods sold per vehicle might be from each factory for each model. We then worked out what price point each vehicle would be at these various margin points. We will now add them into our financial forecasts for 2023 to find out what earnings might come to. From there, we can generate a forward PE ratio to try and gain some reality on the current stock price, based on the future economic climate. I've also reduced the Model S and Model X prices to what they were before they started seeing massive price increases too, and put even them at 20% margin. I've also kept the new factories at 20% margin, although I believe they are currently below that. If they're at 3,000 units a week though now, then you will likely hit volume production in Q1 2023 at this rate, and then I would expect to average 20% for the year. But if there are ramping issues, these factories could end up being lower than 20%. I'm going to start this model with a 20% margin and see what it comes to. From there, I'm going to experiment with many permutations of ASPs and margins and see what numbers we get to find a range of what earnings could be next year. I've plugged in all our ASPs of, remember, base models that have no options ordered, so they will likely be a bit higher. Also, the Chinese models are just the rear-wheel drive versions. I'm not even including the long range, which have higher ASPs. But let's see what this comes to. I have an annual production of just under 2.25 million. This based on what I think is slow ramping for the new factories, not hitting volume production average until Q2, and only ramping up slowly from there. Remember, we're probably at a run rate of 2 million a year already, so this is only an additional 13% more total for the whole year. There are signs pointing to potentially closer to 2.5 million, depending on Tesla's 4680 ramp and the supplies from the CATL factory. I would usually add on FSD as well, but I'm going to keep these prices without FSD in this model. So obviously there is a take rate of FSD, which is higher in the US. Also, FSD prices have risen, and I think after version 11 is released, there'll be less deferred revenue per FSD orders too. So factor that in as a buffer if you like, and we'll go over the fine details later. Also, in a recession, which is what these numbers are meant to reflect, there will likely be less people spending $15,000 on a software upgrade. I will, however, add in $1 billion in regulatory credits. Incidentally, there was $1.6 billion in regulatory credits that Tesla received over the last 4 quarters, so this is actually pessimistic. I've added the tax credits here. Rather than increasing the ASPs of the vehicles, I've added $5 billion, which would mean that 700,000 of the US-built vehicles are receiving the tax credit, or their prices are essentially that much higher if sold in the US, which would be all profit for Tesla. Then another $2.7 billion for the cell and battery subsidies. I'm increasing energy a bit as we know they're ramping up. I'm increasing it to a profit of $2 billion for the year and another $500 million profit for services. I think energy could be a lot bigger than this. It could really make a big difference next year, but we'll stick with a conservative number for this model. I've kept OPEX roughly where it was last quarter, a slight increase, although in a recession this could actually go down. That gives us an operating income of $24 billion. I imagine if interest rates are still this high and Tesla has cash position build up, then they could generate perhaps $250 million in interest, if things are this bad. However, if that's not the case, then rates have dropped, and then hopefully demand has increased for vehicles too. After tax, we end up with a net income of $21.5 billion. At the current stock price of $350 billion, we would have a forward PE ratio of 16. Now that does sound crazy, but remember, this would be what the PE ratio is in January 2025, if all this happened. Something to keep in mind is there could end up being a few $100 million in cost of goods sold or CapEx for changing the Model 3 lines to Model 3 Highland. This will result in some reasonable downtime of the Model 3 production, which would have a big effect on earnings. Once complete though, it will however also stimulate demand for a refreshed Model 3 and reduce the cost of production for the Model 3, and hopefully also improved handling, performance and range as well. It will be a better car and cost less. Although we wouldn't really expect a P ratio of 24 to be that believable for Tesla. Now some people might say that 16 is even high for a PE ratio, but remember this is a PE ratio for a cyclical industry. The competition are likely trading with negative PE ratios as they are making losses. This is also a PE ratio of a company that has grown another 50% over a year, even in a recession. But who knows? The market is not predictable in a recession, and this would also be if the stock is trading where it is today. If we are in a recession, then I wouldn't expect any new factories to be started yet either, so no signs of more growth possibly. You might think compact factory, and perhaps that is a possibility. If it is a possibility though, it would depend on how successful the 4680 cell ramp has been, as Tesla will need a lot more cells for a low-cost Tesla. Anyway, you've seen what prices I put up for the models here. It's up to you to believe how likely you think they might be in a recession in order to still sell this many. Elon did say that Tesla may have to operate at break-even, so perhaps we should review the numbers again then and see what the price points of the vehicles might be if this was the case. As remember, this is not Tesla reducing their prices due to demand dropping because of higher rates and potentially a recession. This is Tesla trying to also grow through that scenario as well. We've just seen them increase supply by 30% in Shanghai, and we're already hearing all sorts of rumors of whether there is still enough demand in China, mixed with COVID issues. It makes it hard to know what is really going on there. And we have seen them dropping the prices around the board and offering extra incentives. So to be clear, these prices are not necessarily what I think they are. These are my estimates of the prices at 20% margin. Although this forward PE ratio does look promising, we have to also face the fact that the current PE ratio is still 34. The market could even decide in a recession that that should be closer to 15. However, we should get a boost for the trailing 12 months earnings, which might go from 11 billion to 14 billion after the Q4 earnings, which would take the PE ratio to 25 at the current stock price. But I think the market cares about next year now, not Q4, and is already starting to look at Q1, and what will that bring? The Inflation Reduction Act is fortunately a huge lifeline for Tesla, providing what seems to be around $5 billion in additional operating profit. So next, we will see just how low the prices for Tesla's vehicles will be at break-even level. It's going to be all about demand, and whether Tesla really does have this much demand in a down economy when they have increased supply so much more. If Tesla is running at break-even or even at a loss, then the stock price could get scary, especially in a recession. However, these prices will likely be exceptionally low. You would have to wonder how bad it would be for Legacy. Of course, Legacy do have the other sides of their business too, to keep them going, and it may be harder on the actual car dealerships themselves. So let me know what you think in the comments. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.